Welcome, everybody. Are you ready to take control of your financial future? Thanks for joining us for part 4 of our Financial Literacy Month webinar in collaboration with RPI Education, designed to give you the tools, strategies, and knowledge to build lasting wealth. Each session features industry experts who will break down complex financial concepts into practical, actionable steps. Whether you're looking to grow your real estate portfolio, optimize your tax strategy, or leverage mortgages for financial gain, then this series is for you. And today we're going to be talking about mastering mortgages and strategic leverage. We've got Nick Lecuyer here joining us, and he's going to fill you in on his background when we get started. We'll be going through some questions for the first half of the webinar and then opening it up for any guests that join us for an open Q&A. But before we get started, I just want to read a very brief disclaimer. The views are presented on this webinar are for general information only and do not constitute investment or other professional advice or an offering of securities. The hosts and guests featured on the webinar make no representations as to the performance of any particular investment, and should you decide to make an investment, you're responsible for conducting your own review and analysis. It's recommended that you obtain independent legal, accounting, and tax advice from licensed professionals before making any investment. So with that said, welcome. How are you both today?
Very well, thanks. Great
Excellent.
job on the pronunciation of my last name. So thank you for
I was like,
that.
are we getting
No,
it
that's
or
great. It was
not?
perfect. Yeah, no, you did a great job. Thank you.
Okay, great. So maybe you can fill us in just to get started before we dive into all the regular questions, just in terms of your background and why this is a perfect topic for you to be talking about.
Yeah, sure. Again, I'm Nick Lecuyer. I own a company called Mortgage Wellness. So Mortgage Wellness operates in Simcoe County. We're Simcoe County's largest mortgage operation. We have 5 offices around Simcoe County. So Barrie, Aurelia, Midland, Angus. And honestly, Serena, what we do every day is just make it happen for clients who are looking to renew their mortgage, refinance their home, purchase a new home, invest in property, build a home. Um, Primarily, the lenders we work with are banks. And that's sort of a surprise to most people. Our top lenders, Scotia, TD, Manulife, National Bank, that sort of thing. So really what we try to do is help as many people as we can in Simcoe County with homeownership, finding a more affordable mortgage, or more importantly, just structuring the right mortgage strategy for them, their investment goals, and their family. We help about 700 people a year throughout Simcoe County. We have a team of about 20. We're an employee-owned company as well. So we just have a lot of fun doing what we do in Simcoe County here.
Awesome. That's not too close for my cottage, actually, so I'll have to look out for you guys.
Yeah,
Um,
great.
Now, in terms of working with commercial real estate investors, what would you say is the split between maybe your residential clientele and your commercial
Mhm.
side?
Yeah, it's interesting. So even as we sit here in 2025, our product mix as it stands right now, which is similar to 2024, is about 55% of our clients are refinance and renewal clients, and 45% of our clients are purchase clients.
Right.
So that's really interesting and a huge surprise to most people, just given the current state of the real estate market, the economy, and everything else that's happening. Most just sort of assume or suspect that purchase business is just way down right now, when in
Yeah.
fact there's tons of people that are taking advantage of the market. So when I break up like the everyday consumer and investors, it's tough to answer for 2 reasons. Because
Right.
the everyday consumer is sort of like a real estate investor in itself right now. I mean,
Yeah.
people just purchasing a home are doing that to take advantage of the market. So
For
like,
sure.
are they an investor? I mean, if Serena, you weren't ready to say, sell and move up quite yet, but you decided to take advantage of the current market, like a lot of people are leaning into the investor space just, to sort of take advantage of the opportunities that are out there in the market.
Yeah.
We work with a ton of investors, a ton of people who are building their new homes, but also, sort of the second reason why that's a tough question to answer is we help a lot of people at the early stages of like buying a home or getting a mortgage. And
Yeah.
as they move down that real estate conveyor belt and the equity opens, then they get introduced to somebody like yourself or somebody like Monica, and they want to take advantage of that equity, and then they become investors. So we sort of serve that full life cycle of like buy a home, refinance a mortgage, renew a mortgage, take advantage of the equity, buy an investment
Yeah.
property, or build a home.
Now, obviously, you're a mortgage brokerage, not a bank.
Yep.
Now,
Yep.
I feel like a lot of times people build those relationships with their banks early on. You get your first debit card, your savings account. So people naturally think when it's time to get a mortgage, I just go to the bank. Now, speaking for myself, because I was self-employed for 20 years, I went to the bank and it was just like, it's not happening. Like,
Yeah.
he did not want to work with me whatsoever. And it was kind of complicated because I had a mix of self-employment income and employment income. And I ended up going the route of a mortgage broker. But for someone that could be new starting out, can you talk about why that would be beneficial to them to entertain a mortgage broker rather than just going to their regular bank?
Yeah, it's interesting, Serena, because that that topic is becoming easier for mortgage brokers. As younger generations start buying homes and seeking mortgage advice, in most circumstances, those people come into our office and have no relationship with their bank.
Yeah.
They don't have the relationship that, say, like our folks would have had with their banker.
Yeah.
To a certain degree, our generation would have had with that same banker.
Yeah.
Our parents brought their kids in to open their first accounts, and I've been with TD for 20 years, sort of thing. Well,
Yeah.
that banker is probably retired. So I find that that line in the sand is about, anybody who's, say, 45 years old and younger has no personal relationship, no
Yeah.
assigned person at their bank. So that conversation is getting easier and easier and easier as our buyers and investors get younger and younger.
Yeah.
Um, Typically and traditionally, people would have a relationship with the bank because they had a go-to. They had somebody that they could just pick up the phone and they could call Susan, and Susan would answer the phone, know their account, and be able to give them quick answers. People are now finding that within mortgage brokers. So
Yeah.
we're their go-to. And if I pick up my phone right now, I can guarantee you there's like 15 text messages from clients, in the last hour since I've been on another meeting that like reach out to us with just everyday questions. We're
Yeah.
their person, right? So the same relationship that people used to find in a bank or a banker,
Yeah.
those same people are now finding that with a mortgage broker. Now, the additional benefit is where a bank, can no longer help a consumer, let's say because they're self-employed, they were employed, a mortgage broker will just stop, quickly pivot, and place the business with a new institution who likely caters to entrepreneurs,
Yeah.
caters to investors, and that sort of thing.
Yeah.
So often we, place, for example, 5 year mortgages with Scotiabank Serena, only to be told that's the limit. Scotiabank can't help Serena anymore. That's our limit is 5. No problem. We'll pivot and go to National Bank where they allow 16, for
Yeah.
example. So that client is left not having to reform a relationship, not left with a no, not left feeling
Yeah.
defeated because they can't continue to grow their portfolio. So mortgage brokers are gaining more and more and more market share
Yeah.
every year. And what we're hearing from our bank partners, TD, Scotia, National, BMO, Manulife, is that the percentage of business that they're getting from mortgage brokers is growing exponentially every year. In fact, one particular bank that I just heard from last week said that 66% of their business last year, huge bank, big,
Yeah.
big, big, huge bank, 66% of their business last year, the mortgages that were originated came from either a mortgage broker or from their mobile mortgage sales force.
Yeah.
66%. So think about how many branches are sitting there, bricks and mortar that they're paying for, and only 33% of their total mortgage book came from all that dead weight brick and mortar branch business.
Yeah. Yeah, and I think that that's just one of the challenges going to the bank is that they've kind of got, the box
Mhm.
that they want to work within, and they generally don't color outside of that whatsoever. So if you don't kind of fit that mold, then that's why it works, going with a broker that can shop things around. Now, in terms of the biggest misconceptions that you find about mortgages, what are some of the common questions that people come to you that, you just feel like you see over and over again, especially when people are just getting their feet wet in the market?
Totally. And the answer to that question is different now than it probably was 3 years ago, but currently right now it's this. Like mortgages are generally easy to obtain if you know what you're after. Like
Yeah.
all too often we meet with first-time homebuyers or somebody that's looking to get into the market or back into the market, and they see it as scary, they see it as a huge hurdle, they don't think they're going to get into the market. When the reality is if they're coming seeking, to explore buying a home, for example, they probably work, they probably have good credit or at least decent credit because, I mean, hey, let's face it, if you have bad credit, right? If people are chasing you for money. And during those times, you don't come looking for a mortgage necessarily. So
Yeah.
you're probably working, you probably have good credit, you have a down payment, or at least you have a plan for a down payment. And for all those reasons, like we break down the barriers and show people like it's generally easy to get a mortgage if you plan for it. Mortgage renewals, like, huge misconception in the mortgage renewal space is this. you don't have to requalify for a mortgage that you already have if
Yeah.
you're looking to do nothing with it. If you're
Yeah.
not looking to move, if you're not looking to increase, if you're not looking to borrow more, they're just going to send you a renewal agreement. Like, stop the fear. People are
Yeah.
calling saying, like, I haven't slept in 2 months because my mortgage renewal is coming up in October. And I'm like,
Yeah.
hey, stop that. Like,
Yeah.
even if you've switched jobs, I talked to a client last week. They've worked in security for like 10 years. They just got a job with one of the police departments. It's a 12-month probation period. Their income dropped by 50% because, there's a scale now. And they are just losing their minds that they won't get renewed. And I'm like,
Yeah.
that is a huge misconception. So,
Yeah.
in these tougher times that we're in, mortgages are still very available. Mortgage renewals are generally very, very easy. You don't have to stress. And then, probably the biggest one and the most relatable is like there are huge opportunities in this market right now. Interest rates are generally very good.
Yeah.
Fixed rates and variable rates are around 4%. And home prices, I mean, are down significantly.
Yeah. Now, I think some of the hesitation that I saw and like things that being in real estate people speculate is that a lot of people coming up for renewal, it wasn't so much that they're worried about maybe getting approved for the renewal as maybe they're going from like a really, really low rate that they got maybe whatever period of time it was, and now they're going to renew at a higher amount. So can they afford that higher amount, right? Is
Yeah,
that
and I
something
think
you've been
that
seeing with some of your clients as well?
and that fear is starting to dissipate a little bit as rates go down. So when they first started talking about the renewal wave coming, or as we jokingly call it in our industry, like renewal Armageddon, rates were at 6%, like high fives into
Yeah.
6%. So people were, staring down a short barrel, thinking that the renewal comes up in a year. Well,
Yeah.
during that year, interest rates have gone down to like 4%. So they might
Yeah.
be coming from two and going to four, but they're not going from two to six.
Yeah.
And they're not even going from two to five. They're going
Yeah.
from two to four.
Yeah.
Now, if they choose a variable rate, which we'll get into, I'm sure after,
Yeah.
there's also opportunity for that to go down even. Now, for those clients that can't afford the increase, we really lean into a strategy that we call tailored debt. And tailored debt is like nothing other than creating a new financial plan for a family. So it's like, okay, your mortgage payment is 1,500 bucks. You have a few credit cards, a line of credit, and a car. Your
Yeah.
total output currently is $2,300.
Yeah.
If we consolidate all that debt into one, your new payment is $1,800 a month,
Yeah.
less than you're paying currently total. And they're
Yeah.
like, well, I don't really care to pay less. Okay, well, let's bring your mortgage payment back up to $2,300, but include all the other things. So it's just one nice, easy
Yeah.
payment. So we just tailor a financial strategy where it's like, hey, the payment's not going to go up. You're going to save more by just having everything into one payment, and you can sleep at night because your payment's not going to go up. You're not going to be stretched. You're not
Yeah.
going to be strained.
No, I think you make an important point. Just when you are talking about people that refinance consumer debt into their mortgage, that you just don't want to get caught in that cycle. And I say that just because I've got a family member that, around the same time that I was buying my first house in 2007, I think they had 100, say $30,000 left on their mortgage. Their payment was around $800 a month. And they're currently sitting at 440,000 on their mortgage. And I think their payment has tripled in the last, what's that,
Mhm.
17 years or something
Yeah,
like that, right?
yeah,
So, I mean, at the point now where they're ready to retire, they should be mortgage free and living pretty comfortably, but instead, they keep on racking up their credit cards, certain expenses, and then every time the refi comes up, refinancing that back in. So, in fact, like even though the equity, the market's gone up, there's still not as much equity as really there should be. So I think it's something to keep in mind that yes, that can be a good strategy to keep certain expenses down, but at the same time, you just don't want to go in that cycle because when you are reaching a retirement age, you should maybe ideally be mortgage free and not, double what you were 10 or 15 years ago, right? So I think it's just something to be really aware of that it's not like you should be treating your house like an ATM.
yeah. It's interesting because if I dug deeper into that situation, I'd probably say to you, over those 17 years with that family member, did you see them struggle, like really struggle, like couldn't buy groceries? And you'd say, no, that wasn't them, for
Well, I mean,
example.
there's things going on that I won't get into great detail, right? So
Sure,
I
yeah,
mean,
yeah, yeah,
there's
yeah,
obviously reasons as to why, but I
yeah,
think it's
yeah,
just, at the bank, they're kind of like, oh yeah, we can do this without maybe, they don't know really the personal
yeah,
situation, what's been
sure.
happening, right? But I
Yeah,
feel it's just so unfortunate because for someone that could be in such a better place is not. In fact, like it's a situation that would, I think, continue to get worse and maybe not even be sustainable, right? So,
Can
Yeah.
I jump in there actually? Because I wanted to say, this is the huge difference between Mortgage Wellness, which we've been clients for, I don't even like 9, 10 plus years, Nick.
Yeah, probably.
And
Yeah. Yeah.
love working with them. And at
Oh, thank
RPI
you.
Education, we're always focusing not just on leverage, but on that strategic leverage. And when we work with Mortgage Wellness, we communicate with them on a regular basis and create together a mortgage plan for the client. And they are so cognizant of the client's personal situation
yeah,
as well as their investment goals, and they
yeah,
never jeopardize people in those situations. And we've had clients where we look at that holistic picture and say, strategic leverage is meant to safely utilize debt. It's never to put anyone in a precarious
for
situation.
sure.
So if we were to have a client that was getting up there, maybe say 55 plus years old, and now committing to an 800,000 mortgage on a personal residence or something, that's something I think all of us as a group would be making well aware that your home really is not an asset. It's a liability. It's only an asset when you're able to leverage to buy these other investment properties. Now,
Yeah,
with investment properties, totally different because in reality, we never really want to necessarily pay off the mortgage
yeah,
in the investment properties. That's something that can keep perpetuating. But before we started working with Mortgage
Mhm.
Wellness and we were with other mortgage agents, it's amazing how people will use leverage and not strategic leverage, meaning putting these people in those precarious situations you alluded to, which is so sad. I agree with you.
yeah,
So we all work together for the betterment of
Yeah.
yeah.
the client.
Yeah, and I
And
mean, I understand you're obviously at the mercy of what someone's telling you, but I just thought I would flag that as a caution because
Yes.
you're kind of referencing, and it can be a good tool. Like, I mean, people have expenses, they've got certain things, but again, it should be something that you use here and there, not like every 5 years,
Every
you
time
know?
you refinance, in a sense, you're spinning your wheels.
Yeah,
Because at the end of the day, mortgage pay down could be great, depending on what the plan is.
yeah,
But if we're working with a mortgage specialist that helps you develop that plan,
yeah,
and we're able to kind of weigh out the risks, the pros, the cons, and continue to evolve that plan and develop that,
yeah.
it's so rewarding how we could help people avoid situations like that. And I
Now,
don't think your bank will do that.
yeah, no, I don't, and that's the thing. She's obviously working at the bank only. Now, in terms of things like eligibility, for the average person coming in as a homeowner or as an investor, can you talk a little bit about eligibility and what they can do to improve their chances, or like what you typically would want to see? Because I know when I started out and I needed, I think my notice of assessment, so like I just threw those out. I didn't know they're important. And now it's different. You
yeah.
can log in on CRA and everything's there. But back then I was like, oh, I don't know what to do. Like I had to probably sit on the phone for an hour and wait to get it. But maybe you can just walk through some of the basic requirements.
Yeah. I mean, income is generally easy to confirm these days.
Yeah,
So being able to access CRA documents online, people can email their pay stubs,
yeah,
getting a copy of a letter of employment or T4s, it's all very generally easy to do. The most difficult part of the process currently is frankly down payment. Like if it's a
yeah,
purchase, banks are extremely diligent in down payment confirmation. I mean, they're accountable to the government for things like AML, anti-money laundering, and that sort of
yeah,
thing. So they want to see like 3 month bank statements for every account. The money is hit. Heaven forbid you transfer it all around or transfer it into one account, that sort of thing. So my word of caution is anybody that's looking to purchase a home, leave all the money where it is. Get early advice on how we're going to structure your down payment, because all too often I walk into one of my staff's offices and there's like bank statements spread out all over the table. There's lines, arrows and that sort of thing. I transferred 20K here, let it sit there. Then I pulled it out, I put it into that account. It's really, really, really challenging to confirm down payment these days. And it ultimately leads to a lot of frustration for the clients when we have to ask for things just over and over and over again. Outside of that, if you want to set yourself up for success, so we'll talk about like sort of the three factors. So income, credit, and down payment. From an income perspective, if you're self-employed, you have two options. You can pay higher taxes or you can pay a higher interest rate. So paying higher taxes will allow you to qualify with any of the big lenders, big banks. There'll be lots of options for you, for example. But if you decide to write your income down to a really low level to save yourself taxes, you have to expect to pay a higher interest rate. You'll be into alternative financing. There's great programs for self-employed people who write down their income. We can confirm their income using like gross business income, business bank statements, and deposits. There's lots of strategy behind that, but the interest rates are about 1% higher. And there's often fees attached to it as well. So clients just don't love that idea. But from an income perspective, if you're self-employed, you have to make that decision. It's income taxes or a higher interest rate.
Yeah.
If you're employed, we use your current income. Now, if you have commissions or bonuses and that sort of thing, keep a hold of your T4s. It's single-handedly the best piece of documentation that you can put aside for yourself, because we can use an average of that income. We can show a trend, especially if it's going upwards.
Yeah.
And again, so often we can use 3 years. Most commonly we use 2 years. As about 3/4 of the way through the year, we can sometimes even use current year prorated if it's on a higher trajectory. So income, it's just a lot of planning. Down payment, you just want to keep very clean. Now, from a credit perspective, you want to keep your balances at about half, even less. But I'm going to say, for the purpose of this call, half of your limit. Very commonly, I meet with clients who have like a $2,000 limit on their credit card, and they'll say, let's say they're in our generation, the three of us sort of thing. And I'm like, get an increase, increase that limit to 10 or 20,000. That person will say to me, I don't really want to go there. Like, it's just, like the higher limit, I was told that's bad. It's great. The higher the limit, the better, provided that you keep your balance very low. Yeah. So if your limit's $2,000, you spend $2,000, you are 100% utilized. Yeah. If you get that limit increase up to $20,000, you spend $2,000, you're 10% utilized. Like, it's a no-brainer. Yeah. And then part two of that is, generally speaking, you want a few credit cards. Again, very commonly, somebody will come in, they'll have one credit card and a car loan, for example. That's like having a 2-question test. So if you get one of those answers wrong, your score automatically falls by 50%. If you have a 10-question test and you get one of those answers wrong, i.e. miss a payment, go over limit, it's 1 of 10 items. So it has a much lower impact on your overall credit score as well.
Yeah, I mean, a couple of strategies that I use. I don't know about everybody else. When I get a bill, I just schedule the payment as soon as it comes in. So then it's like, forget it. Obviously, some people have automatic withdrawals and things like that. And then I pay my credit cards once a week. So I think the banks generally really like me.
See, and you're diligent, right? So I always tell people, like, if you're diligent, especially if you're not diligent, just pre-authorize the minimum payment or the full balance to come right out of your account. Pre-authorized. Everything in your life should just be pre-authorized. That way you never miss it.
No, I think one of the biggest topics have obviously been in the news is just the interest rates. Like, I don't think we've ever heard as much about interest rates as we have in the last couple of years. What are your general takes? Obviously, like, variable was big for a long, long time. Do you have any particular opinion on them as they stand at the moment, and what's kind of projected in the next maybe 5 to 10 years?
The choice between fixed and variable seems to be the choice between liberal and conservative up till yesterday. People are really, really, really set on fixed or into variable. That's always been the case for like the 20 years that I've been in the business, up until the last 3 years. Everything's changed. So, historically, variable rates were about 1% lower than fixed rates, Serena. So, I'd tell you, okay, listen, I can get you a 5-year fixed rate at 4% or a 5-year variable at 3%.
Yeah.
And you'd say, geez, I really want that 1% lower rate, but I'm not into risk. And even though the risk was lower, arguably, over the last, 10 years than it was in the last 3 years, I still don't want the risk. I'm more of a fixed rate person. That's what I used to hear. The people that were variable rate consumers were lifetime variable rate consumers. Yeah. You see now my joke in relation to politics, right? So, you're one or the other in most cases when it comes to interest rates. Now, when interest rates went really low, like pandemic times, there was a lot of fixed rate consumers that took variable rate mortgages. They were just so low. So that variance was, probably around the same, but the interest rate itself was just so low. In some cases, Serena, we saw variable rates around the 2021 mark at 0.99%.
Yeah, it was crazy.
That was an HSBC special. 0.99%, crazy, right? So we saw a lot of people that would typically be fixed rate consumers jump into variable rates.
Yeah.
Now, through the increase of variable rates, we all know somebody who had a variable or adjustable rate. If like friends,
Yeah.
family, coworkers, maybe you had some of your own. I did. Um, prime rate went from 2.45% to 7.2%.
Yeah. Yeah.
Crazy, right? If you had a
Yeah.
line of credit, you were probably prime plus one.
Yeah. Yeah. I think it went up
Eight,
to size 8
eight,
at a
eight,
certain
eight point two
yeah.
percent. Yeah,
Yeah.
same. It's
Yeah.
crazy, right?
Well, and that's, I
Now,
think, the thing, like people usually expect that there'll be like a percent in either direction. No one ever expected that,
no
right?
one
And I
ever
always
expected
often
that.
joke, I'm like, well, they had to pay off SERP somehow, right? So, a
This
lot of
is
times
it.
people just didn't expect that. And now things can maybe level out. And I guess we'll see maybe where the next 5 to 10 years take us. But for somebody that is, maybe they're a variable and then they flip to fixed, or maybe they flip to
Yeah,
fixed, now things are coming down. Can you talk a little bit about what that
yeah.
means for someone as a consumer, like what that cost impact could be on them if they're like, I'm a year into this, rates have come down, but I still have a couple of years left. Like, what kind of impact financially is that going to hit them with if they do decide to make a change?
So those people that really felt the pain over the last 3 years that are in variable rates, for 3 years they were asking me, okay, is it time to convert? Should I lock into a fix? Should I break the variable? Is it time to jump out? They're not doing that anymore,
Well, if
right?
they've lasted 3 years, then I would think at this point
This
they're
is
fine.
it.
It's
You're
more like
right.
if they were going to
Yeah.
switch, they should have switched like after the first increase, not.
But they started seeing it going down, right? They're
Yeah,
like, whoa,
yeah,
whoa, 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 I don't want to lock in anymore. So now we're at this really interesting point where variable rates cost more than fixed rates over the last 3 years. We know that, okay? Variable rates were higher than fixed rates, but nobody wanted to convert to the fixed rate because then they would have locked into 5 or 6% for another five
yeah,
years. It made no sense, right?
yeah,
So
yeah,
they're waiting for them to come down until today. So
yeah,
currently, as I sit here today, first time home buyer, insured mortgage, you can get a 5 year fixed rate for under 4%.
yeah,
You can also get a 5 year variable rate for the exact same rate, 3.95, 3.95. So you have the safety and security of the fixed rate at 3.95 for 5 years. People love that. It's up below 4%. The buyers will get a great deal on a home. It's fixed. That's great. In comparison, they could get a 5 year variable at the exact same interest rate. Now, there's no meeting in May. There's a meeting in June. There's a meeting in July. It's expected that we'll get 2 cuts this year. If we get 2 quarter point cuts, that'll be 3.5% for that first time buyer. Now, there's optimists that say we'll get 3 cuts this year, 3.25 versus the 5 year fixed at
yeah.
4%. So it's a really, really, really interesting thing. What I'm finding right now is a lot of people lean into the conversation on variable
Yeah.
or adjustable, and they want to know about it, and they come right back to the fixed. And they say, you know what, I'm good with 3.95, 4%. So generally around 4% seems to be sort of like where consumer confidence goes up, Serena. And they
Yeah.
say, you know what, I'm good at 4%. That's a great interest rate for me. I'll take it for 3, I'll take it for 5.
Yeah.
But fewer and fewer people, unfortunately, are interested in variable adjustable rates. It's
Well,
just
and
like
you got to just see what's happening in the market, right? Like, I mean, I bought again close to 20 years ago, and at the time I thought, well,
mm,
I was concerned. I was self-employed, so I went fixed, thinking, well, I just want to know like exactly what the payment is. Now, at the time, it
yeah,
was 5.79%. So by the last 15 year
yeah,
standards, that was high. And
yeah.
then everything dropped because then 2008 hit a year later and all the
Mm,
rates got cut. So my broker called me and he said, listen, I think you should break your mortgage. You'll drop from 5.79 to 2.1%. You'll save $250 a month and knock like 10 years off your amortization. So I had to keep calling to find out how much the cost to break it would be. And it seemed kind of like this moving target from day to day, but I
mm,
think it ended up costing like $2,500, but it was still very well worth it because obviously everything got slashed and they stayed that way for so long, right? Like you'd think after the
yeah,
recession, like it probably would have made sense that things would have swung in the other direction ahead of COVID. Like they stayed so low for like 15 years, right? It just
yeah.
kind of crazy when you look like that's probably longer than what the trends would normally look like, right?
Totally. Yeah. And the other thing that's going to be interesting over the next few years, you mentioned penalties. The people that took higher interest rates in the last 2 years,
Yeah.
5%, 6%, that 5.79 was back in the last 2 years. So, I've been telling our real estate partners that we work with, we work really closely with the real estate community. So most of our referrals are coming in from real estate agents. And I've been sort of issuing caution to those folks saying, like when you go in for a listing appointment, I remember when I first got into business in 2007, 2008, and that same thing was happening that you mentioned, 579 was going down to 4%. Those penalties in a lot of circumstances were $15, $20, $25,000. Real estate agents would go in for a listing appointment. And they would sign the paperwork, and of course, the next move was they would call their lender, call their bank, call their mortgage broker, and say, "Okay, I'm moving," and find out that they have a 15, 20, or $25,000 mortgage penalty, and they're like, "Okay, no." Serena said that I'm going to list my home for already 100,000 less than
Yeah.
I thought
Yeah.
it was worth, and now I have to pay $25,000 as a mortgage penalty,
Yeah.
commission, lawyers,
Well, I guess
appraisals,
you're not
placement
paying that
fees.
penalty if you're porting it to a new mortgage though, right? It's only if they're selling and not like selling within that window, right?
Yeah, it's true. It's just a lot of people when they're moving, they want to get rid of that higher rate and take advantage of the current interest rates.
Right.
So what I find a lot of people do is like if they know they can't take advantage of today's interest rates and they have, a short remaining term on their existing home,
Yeah.
in a lot of circumstances right now, they're just postponing the move plan. They're like, well, the market will be better, my mortgage will be up, et
Yeah.
cetera, et cetera. Now, of course,
Yeah.
there's other consequences, right? Homes might be more valuable at that point.
Yeah.
There might be
Yeah, I
more
feel like
months of
it's been a holding
inventory.
pattern just speaking from the standpoint of an agent.
Yeah, yeah,
I've
yeah,
got people that were like, yeah, I'm ready to go like next week. And it's been like 6 months,
yeah.
everyone's kind of like hanging on. So I
It's
think,
always
you
next
know,
week.
yeah, I mean, everyone says that, right? But I've even had
Mm.
lockboxes on 2 properties since the end of November and they're still like, are you ready yet?
Oh, wow.
So
Yeah.
yeah, it's been kind of interesting, but then they're gonna, again, depending on what their plan is, right? Like if they're just planning to sell, then waiting probably made sense because now we're starting to see some like multiple offers coming back.
Mm.
Things are starting to trend upwards again, right? So I think it just
Yeah.
depends if you're looking to buy and sell. Like I think for anyone right now, I would definitely suggest selling before buying, but
Hmm.
everyone's going to move at their own pace, right?
Yeah, absolutely.
So in terms of things like leveraging the equity in your home for real estate investment or private lending, things like that,
Mm.
can you talk about your opinion on, the best way to manage that and take advantage of the equity that you do have available for investment purposes?
Totally. Yeah. This is our secret sauce. We do this all the time. So, Monica and I actually have a recorded webinar where we show people how to calculate how much available equity, not equity totally, but available equity is in your home, and then how you can calculate what you can buy using that equity. So the math would go something like this, Rena. My home is worth $1 million. I can borrow up to 80%, so that's $800,000.
Yeah.
My existing mortgage is $500,000. So that allows me to unlock or utilize or borrow against $300,000. And that's great to know. Like we run people through that every day. But then what we do is we extend it a little further and we say, okay, what can we do with the $300,000? Now, we have something that we call the rule of five. Like most banks, most lenders, most institutions will let me own 5 homes. That's a bank, pardon me, my primary residence, a cottage, and 3 rental properties, or just my primary res,
And why
4
is
rental
that? Like it
properties.
just seems like so restrictive.
It's risk. It's risk, right? Like, banks always think about worst case scenario. So when they lend you the money, they think, is Monica going to default on this mortgage? And if she defaults on this mortgage, do I have to take back? Am I going to be able
Yeah.
to sell it? Is it up north? That's why sometimes like rural properties, commercial properties, multi-unit properties are harder to finance because in the bank's eyes, they're less marketable. They'll sit on the market longer if the bank has to take that property back.
Okay, got it.
And they
And
mean less to us too.
yeah,
Lose your home. You don't want to lose your home. You don't want to lose your
mhm,
cottage, but you'd be more willing to lose an investment property than you would your
mhm.
house or your cottage. Because
Yeah,
they know you're not living in it, so you have less to
to
less to lose.
lose. Yeah. And the way they look at it from that risk perspective is like if somebody's house of cards falls, what's going to go down with it, right? Is it 5 of their mortgages or 1 of their mortgage? That sort of thing, right?
Right.
Is there going to be 5 creditors that are seeking remedy for default from that same person, or one bank that's going to be
Yeah.
looking for them, that sort of thing. So, in this sort of circumstance, if that person had 300,000 available, we would say 300,000 is 20% down on what amount of mortgage?
Right.
And the answer is $1.5 million.
Yeah.
300,000 is 20% down on 1.5 million. And we'd say, okay, great. Well, Monica owns 1 house right now, her primary residence. Monica doesn't own 1 house, but I'm just using it as an example. Monica likes buying houses like I do. So, let's say Monica owns 1 house. That theoretically, she could buy 4 homes. So can she buy 4 homes for $1.5 million? Probably not, right? Because that's like the homes would have to be
Not here.
around 400,000. Yeah, $400,000 a piece or less than
We're
that,
not going to Timmins.
Yeah.
Yeah, right. So can she buy 3 homes for 1.5 million? Well, that's 500,000. Maybe not, right? So can she buy 2 homes for 1.5 million? Absolutely. That's 750,000
Yeah.
each. It's maybe a couple duplexes in Barrie, it's a couple triplexes in Hamilton, like that sort of thing. So then we set our target on, okay, Monica, let's grab that 300,000, grab access to that 300,000, make it available in a home equity line of credit, and go searching for 2 homes at about 750 or less, so that we can really build out a plan. So that's how we typically see clients, build that plan, like see what's available, utilize their equity, and then take advantage of like untapped equity in their home.
Yeah.
Everything
And
that
I
they
think it's
borrow
important
against.
also to just like you're talking about buying 2 properties, for example. And I think it's just really, you have to also be very careful, especially in Ontario, because the LTB rules are not favorable to landlords, right? So you've got great equity appreciation, but just know that if you ran into issues with a tenant, they stop paying, can you also afford that payment of shouldering their rent for a year or more while it goes through the LTB process? And what I've often talked to people about as well is just not to be afraid to look outside of your own backyard, because maybe Alberta could be better, maybe New Brunswick, maybe even parts of the United States where you've got more control as a landlord, maybe your affordability is better and things like that. So there can be other things that you consider. It doesn't necessarily need to be, as close by as an hour away. And people just have to get used to the idea of like, maybe you can't go touch and feel it all the time and go buy if you want to, but that really comes down to your team. But you just want to look at things from worst case scenario as well, because I think that's an issue. A lot of, things that you see in the news, you've got these small landlords, like if they just have a condo or a couple of properties, the non-payment of rent can be crippling, right?
At RPI Education, our only defense to that, and we always tell our clients that this is a really great possibility, and it could be a year and a half. Fortunately, now it's more of an 8-9 month process, but it could be financially crippling. The best way to do it, that we plan for it, is the lenders often help attach a line of credit. As well, or we tell them to have, often they have a secured line of credit that is utilized for this purpose specifically. So it will stay at
Yeah.
zero. But if worse comes to, worse situation, we really encourage people to pre-plan for that happening, because that's the best thing about investing in real estate. It's the only investment where you can pre-plan everything going wrong and have, a solution prepared in advance, even including mortgage rates. We were consistently always doing mortgages at 6 and 7% to make sure it was still working and still cash flow positive, even though we were securing much lower mortgage rates.
Yeah.
So yeah, that's what I absolutely love about that. And sometimes mortgage agents are able to help you get these secure lines of credits as well for these specific purposes, also for, say, repairs or any just unforeseen.
Yeah.
You don't have to use it. You can keep it at zero, but it
Yeah.
just sleep better just knowing it could be there.
Yeah, no, for sure. Now, in terms of things like paying off a mortgage, what would you say are some of the best tools that someone can use, to become mortgage free faster?
Oh yeah, this is one of my favorites. Okay, so there's a misconception that I need to go biweekly or weekly to pay my mortgage off faster, or I need to take advantage of my mortgage anniversary, and make a lump sum, for example. Now, there's a few different ways to take advantage of paying off a mortgage faster. Biweekly and weekly payments, definitely one of them. Lump sum payments, absolutely. There's fewer and fewer people that have like a lump sum, like 50 grand or 70 grand at renewal or throughout the year, for example, to lump onto their payment. So one of the strategies that we implement is like small baby steps. You can pay monthly. I mean, hey, if it works best for you, pay monthly, but take advantage of your payment increase options. So we can all relate to this. You get a mortgage and the monthly payment is $2,639.84. Great, right? Why not 2,700?
Yeah.
Why not 2,800? So we always like to sort of connect with our clients and say, hey, how about a small increase? Like, do you want to just round this off right out of the gates? Instead of 2,734, do you want it to be 2,750? Do you want it to be 2,800? So I would encourage everybody, like, set a reminder in your calendar every 6 months. It'll pop up, increase your payment by $50, by $100. those small steps really, really, really help,
Yeah.
Now, we were telling people to do this to get ready for renewal as well. So those higher interest rates coming, start increasing your payments slowly every 6 months. Like if you, 3 years ago, if you knew that this renewal wave was coming, interest rates were going higher, you were at 2%, your payment was at 2,000, we thought it was going to go to 2,500. We would
Yeah.
tell clients, okay, you have 3 years to get up by $500.
Yeah.
Let's, divide that by 6 month increments
Yeah.
and say, okay, how much every 6 months do we have to increase this payment? And I can promise you those baby steps probably will not be noticeable to your finances.
Yeah. No, that's a big one. Now in terms of creative financing options, so for buyers that don't qualify with traditional methods, can you talk a little bit more about what that looks like?
Yeah, so this is what we call the mortgage triangle. So the mortgage triangle is essentially, education for borrowers where we show them that, you have to have sort of like two of the three pillars. So picture like a bar stool, like if you don't have two legs, it's going to fall over.
Yeah.
So those three pillars are income, credit, and equity. So we'll talk in the circumstance of a purchase, for example. So if you have really great income and really great credit, you can probably get away with a minimum down payment, like, 5 to 7% down, for example, depending on your purchase price. In Simcoe County, for example, there's a down payment assistance program. We help clients with it all the time. It provides 10% of your down payment as a grant. You don't have to come up with anything, which is great, just closing costs. But to get that, you have to have the other two pillars very strong, be it income and credit. You see that equity piece can be a little less reliable or a little, the weaker part of the equation.
Yeah.
So let's go to credit, for example. If your credit leg on the stool is very weak, your income should be very strong and you should have a big down payment. So if somebody called me and said, listen, I just went through a bad divorce and my credit's destroyed, but I make $200K at my job and I have $300,000 to put down on a $600,000 home, their income piece is very strong. Their equity piece is very strong. Just their credit piece is not. So there's creative options. But, if you have two of those three pillars, there are tons of options for you. Where we have to be a little bit more creative is when maybe all three pieces are a little weaker.
Yeah.
For example, I'm self-employed. I have less than a 20% down payment,
Yeah.
and I'd like to keep my balances on my credit cards high because I write off that interest to my business, for example. That's a trickier one. But then what we do is we just kind of like architect a situation in that mortgage triangle that will work for that borrower.
Right. Now, for somebody that does have bad credit, can you talk about things that they can do to remedy it?
Totally. Yeah. So what I typically find is people that have bad credit often have their head in the sand, like they don't want to deal with it. So one of the things that we have to do is like break down the barrier and say, listen, let's take a look at the credit bureau. We'll pull it up on the TV screen right here so that we can go through it line by line. And here's how it usually goes, unfortunately. The first section shows their score. They go, yeah, that I know. And then I go to the next
for someone, what is a good score?
So scores go from like 350 to 900. A great score is over 700. That's really where you want to be. You'll see all kinds of literature online saying like anything over 650, 680. You want to aim for over 700. 700 to 800 is all generally like A plus.
Okay.
800 to 900 plus. So that's great. If you stay in the 700s, you should be able to accomplish anything you're looking for.
Yeah.
So when we scroll down on that credit bureau, the first section is collections. This is a really interesting one. And I'll say, there's a collection here from Enbridge for $1,000. And the answer is always the same for somebody that's, running from it. For example, they'll say, I'm not paying them. The heck with them. I don't owe them that money. And I'm like, hey, whatever the dispute or the debate is, it's going to be a longer process to fight it than it is to just pay it, then fight it. Because we can start today. You can start like as soon as you pay it, your credit score automatically gets better. The next one down, they'll say a dentist, $300, and they'll say that guy ripped me off, and they'll say pay it, get it done with, deal with it. Home Depot, they shouldn't have charged me the interest. I had a 12-month thing. I'm like, pay it, then go fight it, because we can draw the line. We can draw the line in the sand and move on, right?
Yeah. And it's interesting just to see it. I remember when I had my business, I was applying for a loan because I was building a software platform. And they're like, oh, there's something on your Equifax for our business. And it was really unusual because when I looked it up, someone had opened a company name the same as mine, and they had like a Cogeco bill owing. And I was like, well, my name's not Mohammed. I've never lived in
Yeah.
Hamilton. So,
Yeah.
you know, they were pretty good about getting it off. But the irony is, I guess, whenever Cogeco tried to just find this person, because our SEO was so strong, they just found our business and assumed it was us and just tacked it to us. So I think it's good practice as well, even if you're not necessarily buying a home, like maybe even just check up on your credit every few years, because sometimes things can end up there that you like shouldn't even be there, right? So it's
Uh,
one thing to say, well, I know I didn't pay this bill, but it's another thing that like sometimes things just happen. So
yeah. And you know, that's a great point, honestly. Like people will say to me, like, you know, I follow it on like Credit Karma or Borrow Well or whatever, and they sort of like roll their eyes as if like I'm gonna make fun of it. I'm like, no, no, you absolutely should be doing that. Like,
yeah,
I mean, those systems are fabulous. I mean, I subscribe to it. It sends me little
yeah,
updates. Your scores increase, your scores decrease. I'm like, decrease. I click
yeah,
on it and I, yeah,
yeah.
yeah, yeah. So you know, all of those systems serve exactly their purpose. I mean, like
Yeah,
use them, have them monitor your credit, knowing GI Joe said knowing is half the battle, right?
yeah,
Like
yeah.
you have to know. It's way better than when clients come in and I'm like, how's your credit? And they're like, I don't know. You know,
Yeah.
you want to
Yeah, I
know
saw a
for
quote
sure.
recently. It's like if you can't measure it, you can't manage it, right? So I think that's a
Absolutely.
really good
Yeah.
quote when it comes to your finances, because
Yep.
you know you want to be very well aware of what's coming in, what's going out, when things are due, and that's I think a way that you can achieve the success that you're looking for when it comes to either buying a home or getting into investments and stuff like that. Because I find
Yeah.
it blows my mind when people like they just don't seem to know what kind of financial health they're even in. Like they could say, well, I make a lot of money. Well, they're spending a lot of money, right? So you're
Hmm.
not really financially healthy because it's what you
Hmm.
keep, not what you're spending, right?
Totally.
Now, for anyone that is tuning in after, is there anything that you'd want to leave them with, just in terms of high level tips, strategies, or anything that we haven't covered so far?
You know, like I'll tell you this, you know, there's two sort of sad stories that we see in our business right now. The first one is, you know, not going to be a surprise to you. It's, you know, rates went high. My home equity was low. I was using my home as an ATM and I can't anymore because the value is not high enough. We're getting the calls from people saying like, you know, I can't afford to keep my kids in daycare. And those are very sad stories, right?
Yeah,
When somebody's equity is completely tapped because they have, you know, dug into their home a few times and it hasn't appreciated like it has in the last 15 years, for example, you know, that's a sad story. We do our best to help those clients restructure, rearrange, and that sort of thing. The second sad story, arguably even sadder, is people just like us, I'll say our age, I think we're all around the same generation, who have good jobs. Let's say they both work at Hydro One. They both make $100,000 a year, but they have two kids. They started late in life, and they don't have the $50,000 or $60,000 to break into the housing market, and they're stuck renting forever because their only barrier. They have good credit, they have great jobs, they have good income.
down payment.
Their
Yeah,
only barrier is that down payment to get into the real estate industry
yeah,
or the real estate market because we know the home is eventually long term going to go up. We know the mortgage is going to be paid down. They'll build equity, and that equity can often and most often help them weather, you know, job loss, financial
yeah,
crisis,
yeah,
illness, sickness, helping family, sending kids to school, like all of these things. That they don't have that, Serena, it's a
yeah,
really sad story because you compare two couples, okay, in their late 50s, and I'll show you somebody who owns a home who's been able to weather like
yeah,
general life storms, health, illness, sickness, job loss, divorce, all of these things, okay? And their house and their real estate investments have helped them get through that. The
yeah,
same couple who never owned a home, and I'll show you a bankruptcy
yeah, yeah,
because how else are they going to get through it?
yeah,
You know, there's no safety net. So
yeah,
I would tell everybody who's on this call, like, you know, you need to own real estate in Canada. As a
yeah,
Canadian, you need to own real estate. One piece, two pieces, three pieces, whatever. You need to own real estate. It's a great safety net. It's a financial plan. It can help you retire, it can help you weather bad situations, it can help you invest. You need to own a home. If you
yeah.
don't own a home, reach out, get advice, get in the market.
Yeah, yeah, no, absolutely. And there are other strategies that can help, right? Like things like rent to own, house hacking, like there could be other
Mhm.
things that you can do that maybe, it's not a long-term solution, but at least it helps you get your foot in the door, right?
Well, if
Totally.
you have the
You know,
real estate already, it's a lot easier to fix the problem. And if you want to get your foot into the door, Nick's right. Every Canadian needs 1 to 3 properties in their portfolio, even if they're not full-time investors.
Yeah.
And everything's fixable. You just have to use your professionals. I think a lot of the times when people have these struggles, they get embarrassed, they hide their head in the sand, and they don't utilize their resources. And
Yeah.
there's no shame in this. Everything really is fixable, and it's not a time to panic because you have amazing experts like Nick that are there to help you.
Yeah.
And it's not as bad as it seems a lot of the time. So.
Yeah. Awesome. Now, Nick, for anyone that wants to get in touch, I think we had a couple people come and go. Kathleen, do you have any questions for Nick or for Monica at all? Coming in? If not, otherwise, Nick, Monica, what's the best way for someone to get in touch with you if they want to reach out?
Yeah, reach out to us at mortgagewellness.ca. All of our contact info is there. You can book a virtual consultation. If you're in Simcoe County, you can book at one of our offices in Simcoe County, but would love to connect.
Cool. Well, thank you for your time today. And for Monica, we've got your information in the show notes below as well. And of course, for everyone that has tuned in or will tune in after, remember when you invest in your